You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is real estate investment expert Ellie Perlman. Ellie is the founder and CEO of Blue Lake Capital, a real estate investment firm specializing in multifamily properties. Her current portfolio spans over 2,000 multifamily units spread across the United States. Now, she first started her career as a commercial real estate lawyer, leading commercial real estate transactions for Africa Israel, which is Israel's largest development company. Later, as a property manager for one of Israel's most prominent oil and gas companies, she oversaw properties worth over $100 million. Now, in addition to her real estate activities, Ellie is a Forbes author on real estate investing, the host of the podcast That Really Happened, Unbelievable Real Estate Stories. And she's also a writer of a weekly blog you can find over at her website, which is ellieperlman.com. Now, guys,
I'm very excited to get onto the show with Ellie, but first I have a few housekeeping items I quickly like to run through with each of you. First and foremost, I just want to wish each and every one of you an awesome 2019, right? Happy New Year. I hope that through the information shared on this podcast that I can help you achieve your investment goals for the year, or at least help you get closer to them. And just so you know, I really am here to help each and every one of you. In fact, there are a good number of you who I've connected with over the years and even partnered with on deals over these last few years. And so here's a few different ways of how I'd like to help you or how I can help you, some of the resources I can offer. Maybe you have a deal, but you need capital or you need an operational partner. Well, I'm here for you. Maybe you just need some guidance. You're getting started in the commercial real estate investing world. I can help you with that too. Or maybe you're just looking to diversify your investment portfolio and you're considering different types of investment vehicles and maybe mobile home parks, which is the one that we specialize in. I've got a solution for that as well. Bottom line, I want to be a resource to you. And just in case you weren't aware of it, I also host another weekly podcast, and that goes by the name of the Mobile Home Park Investing Podcast. And on this show, we cover why our team absolutely loves mobile home parks and why we have chosen this asset class as our core focus. Now, on this show, we go into granular details of how we built our mobile home park business over these last couple of years and how we continually source off-market deals, even in highly competitive real estate environments like we find ourselves in today. And lastly, we show you how to achieve huge returns in the mobile home park niche. Now, be sure to go check it out. And one other thing, if you go over there, this is something that if you've never been there, you don't know about. We also give away the exact cold call script that we use to call owners directly. But you'll have to listen to an episode to find out how you can get a hold of that free gift. Again, it's the exact cold call script that we use in-house. We have a full-time in-house person that all she does all day long is outbound call property owners. In our case, it's mobile home parks. But this cold call script will work for any different type of real estate that you have an interest in buying, whether it's multifamily, shopping centers, self-storage, it doesn't matter. It can be revised to fit any different type of investment vehicle, okay? Now, another quick update I'd like to share with you guys is of the incredible success as we go into 2019 that we had looking back in 18 with our partners, okay? I always like to praise both our team and our partners for the successes that we had. And 2018 was an awesome year. We launched what is currently our most recent investment offering, which is MHP Growth and Income Fund 2. We launched that back in May 2018. And we launched with the initial target capital raise of $10 million, which we fully subscribed in less than 5 weeks. We had a very active year. In 2018, we purchased 8 mobile home park communities that represented over 800 lots that we added to our portfolio. Now, as most of you guys know, if you've listened to the show for quite some time, we really pride ourselves in our ability to source strong off-market deals via direct-to-owner marketing efforts. And we suggest that you guys do the same. And it doesn't matter if you're buying mobile home parks, multifamily, single-family, self-storage, shopping centers. Again, it doesn't really matter. These types of strategies work in any different niche that you might be in. Now, back to the exciting part of all this is that only one of the 8 communities that we bought last year was actually through a broker. And I know most of you probably rely on brokers to find your deals. And I love brokers. I got a lot of broker friends, and we still buy deals through brokers. And we have a lot of close relationships with brokers. But the best deals typically are found when you go direct to owner, okay? We're not competing against other buyers for the same deal, and we're not getting priced out of deals because of that, okay? This is really where we shine. And with that, we're rolling into 2019 with a incredibly strong pipeline, and we just recently opened up the second tranche of our MHP Growth and Income Fund 2 offering, okay? For all those investors that maybe had an interest in working with us last year, but they missed out on the opportunity to invest, well, guess what? Your opportunity is back open again, and we'd love to work with you. And I'll tell you that the time really is now. While there's a ton of others out there overpaying for multifamily properties and mobile home parks and all other types of real estate, we're actually buying great deals still, okay? So if you're an accredited investor and you're interested in learning more about partnering with me and my team on future deals, I'd love to have a conversation with you. If you'd like to learn a little bit more about our company and read through our investment docs, you can go to invest.sunrisecapitalinvestors.com, where you can create a free account inside our secure investment portal. And inside here, you'll have immediate access to our offering docs, a PPM, and all the webinars, which cover all the intimate details of our investment opportunity. And I'll just leave it with this, guys. Based on how fast we filled up this first tranche back when we launched in May of 2018, I'm quite confident that this current opportunity, it won't last very long. I can promise you that. And so I do look forward to the opportunity of working with you. And with that, before we get onto the show here with Ellie, if you happen to find yourself in the Tampa Bay area, that's where we're based out of. We're actually located in Safety Harbor, Florida. That's where our offices are. It's about 20 minutes across the bay from the Tampa Bay International Airport. We'd love to meet you. So come visit our office. I'd love to take you to lunch, buy you a coffee, buy you a beer. If you find yourself in Tampa, you got some extra time to kill, you'd like to come see us, I love meeting others, whether you're interested in mobile home parks or any other type of real estate. If you're just a loyal listener to the show, I'd love to meet you. Go to our website, sunrisecapitalinvestors.com. Go through the Contact Us page. You can also reach us through kevinbupp.com, which is my personal website. Go to the Contact Us page, submit an inquiry, let me know when you're coming to town, and I'll look forward to meeting with you.
All right, guys, now without further ado, I'd like to welcome Ellie Perlman to the show. Ellie, how you doing today?
I'm doing great, Kevin. How are you?
Oh, I'm doing great. Thank you for coming here. I know you're super busy, so thank you for taking the time out of your day and your schedule to join us here. Very much looking forward to diving into your background, your story a little bit, and just learning what it is that you do and how you've done it. So maybe if you would, I give you the very brief, abbreviated background or introduction. So maybe if you could, Ellie, maybe take a few minutes, give our listeners a little bit more insight of your background and how you got into the real estate space.
Yeah, absolutely. So I actually started my career in real estate before 2007. So I started as a lawyer, and I was working on very, very interesting deals, and then transitioned to property management, which is not a normal transition to become a lawyer and then manage properties. But I loved real estate, and I knew that I loved real estate pretty, very early on. So after that was all in Israel. After that, I decided to move to the US. I went to MIT, got my business degree. I wanted to learn more about real estate from the business angle and how to strategize, how to build companies, and how to build a real estate business. And then transitioned again to investing. And that's what I do. And as you mentioned, we buy multifamily properties. That's all we do. And I'm having a lot of fun. It's a great industry, and I absolutely love what I do.
Yeah, and that's what it's all about, having fun, right? It doesn't really matter what angle you choose and whatever it is you choose to do, whether it's real estate investing or some other type of business, but it's all about having fun. And, I always like to tell Ellie, I'd like to tell folks that are just getting started, like there really is 1,001 and probably more, but 1,001 or more different ways to make money as a real estate investor. And just because you're doing really well and you're kicking butt in multifamily doesn't mean that that's for, maybe one of our listeners. Maybe it's one of the other many asset classes or types of real estate investing that you can do. And so in any event, you're having great success with multifamily. And so I'm really interested to really dig into that story. And so give us an idea, just so we have a better understanding of when you really got your start as a multifamily investor. So like, what year did you actually buy that first multifamily investment?
So I actually started with my husband as a passive investor. Okay. years ago. I think probably around 2010 was the first investment.
Okay.
And it was actually very interesting to learn, the business through other syndicators, people with more experience. That was a great learning experience for us. And I didn't know back then that I actually wanted to become a syndicator and run my own real estate company. I knew I wanted to be in real estate. It wasn't clear to me in what capacity.
Mm-hmm.
So that's basically, how it started for me.
Do you feel like you actually gained some pretty good knowledge and insight from being a passive investor in those syndications? I know it can vary from sponsor to sponsor. Some syndications, really the passive investor is not really going to learn too much. Others, there might be more, not necessarily involvement, but they get a little bit more of a play-by-play game plan overall of what's going on in the deal. So give me your experience as far as being a passive investor and what kind of knowledge you gained from that.
Yeah, and I think you're absolutely right. It really depends on how open and sharing the syndicator is. So from a passive investor's perspective, I was exposed to the business plans of exactly, how you can take a property and reposition it. I wasn't there, obviously, managing the deal, but I was exposed to materials and I read and I learned how syndicators look at a deal and how they evaluate an opportunity. So, for instance, I understood that they were looking at the competition and analyzing the market this way to understand what are the needs of tenants and what they're able to pay for, and basically bring the investment to the same level of renovation so they can increase the rents. And that was a foreign concept to me before that. I didn't know what I didn't know, right? So that's, basically, you start from scratch and just learning also what factors they're looking at in terms of the returns, the differences between cash and IRR. And the better syndicators have the capacity and the willingness to sit down with you and explain concepts with you. And I like learning on my own. So I invested time, studying the subject. So it was more, I think, about learning the business plan and how they evaluate it from the business point of view and how they choose markets. So you can, as a passive investor, you can, ask, why did you choose this specific market? And you can actually see that in many materials today. Mm-hmm. You look at a package and you understand. And I think it's not only for multifamily, but for other asset classes that you can actually see, this is what we think about the opportunity. That's why it's a good one. This is why we chose this market. And you can see something that is kind of the same. You see the same subjects and the same theme over and over again. So you see, for instance, the way to choose the market is by the population growth and the job growth. You see that over and over again. So that's a great way for many investors to start in real estate. And I actually have some investors that want to become syndicators, but they don't know what to do exactly and how to start learning about it. So for them, the best way to do it is to invest passively. And it also helps a little bit with credibility because they are part owners in the same space that they want to, that they want to lead in the future.
Got it. Do lenders give a lot of weight to a limited partner being invested as a passive investor in a syndication? I mean, as far as if that passive investor is going to ultimately go out and be a sponsor of their own deal, does it truly benefit them a great deal in the eyes of a lender?
To some extent. Of course, okay. I mean, it's always better if you're on the general partnership side. Mm-hmm. But obviously, when the lender looks at a new business opportunity with a new investor, they're trying to understand how experienced the investor is because they want to understand the investor's ability to analyze deals, to understand what they're doing. So without any experience, that's very hard. So with little experience, even as a limited partner, that's better. And if you partner with someone and you're on the general partnership side and you're on the active side, then it's even better than that. So, of course, there are better ways of improving your position when you're looking for a loan, but that's definitely one of those.
Got it. I want to back up a little bit. I want to talk about the period of time that you decided that you really wanted to dive in and sponsor a deal and move from the passive role to the more active role. When did that come, in your investing career? I mean, was it like in the first couple of years? Did it take a while? And then ultimately, what was that light bulb or what was the light switch that went off that said, you know what? I want to do this myself. I can whether I can do it better, I can find better opportunities. It's going to be more lucrative. Like, what was that driving force that made you go from the passive side to the active side?
That's a great question. For me, once I understood that real estate investing was my path, then that was it for me, was moving forward in full speed. So when, as a passive investor, I had other positions. I was working as an employee. And so I had other things on my mind, and I didn't have the time to really, focus on running a business, because it's a business. I don't think you can successfully do that as a side hustle. Maybe if you partner with someone and you help raising capital, that's one thing.
Yeah.
But being a syndicator, full-time syndicator, and have a full-time job, I just don't see that really working out. So when I realized, it's actually a very interesting story. It was a time in my career, I was transitioning between positions, and I was working in the tech industry, making six figures, was very bored and unchallenged. I think the work was a little bit too easy and not very challenging. And I was at a point in my career when I was transitioning from one company to another, and the offer fell through during the negotiation. I thought that, for me, with my experience, I was able to get a certain salary, and the company that was interested in hiring me thought differently. And that was kind of a breaking point, to be honest, because I thought I got the job and I didn't.
Mm-hmm.
And that made me see things differently. I understood that if I wanted someone to evaluate my skills and my value and write a check, I prefer that it would be through investors investing in my company than through an employer writing me a check, every 2 weeks or every month. And I just had this desire to be the general of my own path. I wanted to create something, and I'm building an empire, and I wanted to create something that I can inherit to my, kids and start and build a legacy. And it's really hard to do that when you're working for someone else. And there's nothing wrong with working for someone else. I have people working for me and helping me build my empire, but it really depends on what you're looking for and what you're comfortable with. And I was in a place where I was just uncomfortable of being overly comfortable. And that's why I tried to find a new career that would challenge me. And that brought me to a place where I felt that I wasn't valued enough. And that changed my perspective. So that was the point that I actually transitioned to full-time syndication.
What were some of the roadblocks you encountered moving from that passive role to being a syndicator? I mean, it's a completely different ballgame, lots more responsibility, obviously, on your shoulder. There's no responsibility typically in the passive role, but the roles get flipped, 180, and now everything's relying on you to ultimately source a good opportunity, underwrite it properly, and then actually manage that asset as well. Maybe not necessarily manage the day-to-day, but find the right property management fit and, become that asset manager that is solely financially responsible for the performance. And so talk to me about the roadblocks that might have come up along the way and ultimately how you overcame them.
Yeah. So I decided to partner with someone that was more experienced than me. And that helped me tremendously because I learned the business and I could rely on someone that knew what they were doing. So by the time I was on my own, I knew enough to manage other people's money. And I mean, generally speaking, you have three ways of doing that, right? One way is to just dive in and do it on your own, which is fine if it's your own money. But I think when you bring investors' money into the game, you want to make sure that you know what you're doing. They have enough experience. And the second way is to get a mentor. And I did. So you can get a mentor, someone who can teach you the ins and outs of investing and help and guide you through the whole process. And the third way is to partner with someone with experience. So you bring something to the table. You can sign on the loan if you have the right net worth. You can help bring capital. You can maybe find a deal. You can help manage the property. There's so many ways that if you're just starting, there's so many ways to contribute and partner with someone and bring value, even if the other person is more experienced. And that's a great way to learn and build credibility. It helps also, of course, bring capital to the deal. So I did I got a mentor, and I also partnered with, someone who was more experienced than me. And I just think it's, I don't think any doctor starts operating without, trying to operate, try with simple kind of operations and have someone next to them with a lot more experience to guide them through the process.
Sure.
So make sure you're not, that you have enough experience through either paying for someone to teach you that or partner with someone who can actually show you the way, or both.
Got it. No, that's great advice. Let's talk about the markets that you're invested in. I know before we started the show here, you'd mentioned a few different ones. I think Florida was one, and maybe Texas, and there might have been a couple others as well. What are the different markets that you're invested in? But not only that, but why did you specifically choose those markets?
So yeah, I'm investing in Texas, Florida, and Georgia. And the reason for that is that I always look for 3 points of growth and a fourth factor that I'm going to talk about in a second. So for a market to be a solid market, it has to have job growth, population growth, and rent growth. And they're all connected. So if companies are coming to a certain market, then they have job growth. And that brings people, because people are looking for jobs. Mm-hmm. And when people move to a certain state, then demand increases. When demand increases, for multifamily, then you have rent growth. So I'm looking for markets that are growing. And I found that especially in Texas and Florida, which are the states with the highest internal migration within the US. So for instance, in Orlando, one of my submarkets that I'm focused on, there has been around 7% rent growth in the last year. Dallas had over 120,000 new jobs in the last year. So these are the markets that I'm focused on, markets that bring people, that companies are moving to, and that rent is growing. And then the fourth factor that I mentioned earlier, I hinted on, is landlord-friendly state. For me, it's really important to be in a place that actually helps landlords more than tenants. So, I live in California and I love living in Santa Monica. It's a little bit of a challenge to invest here because if your tenant doesn't pay you as a landlord, you can wait for 9, 10, even 8 months or a year until you're able to evict the person. And during that time, nobody's paying rent and all the expenses are out of pocket. So it's really different in the markets that I invest in. So I want to make sure that I'm actually in a place that understands landlords and actually support them. And that has been working out pretty well for me.
Okay, fantastic. And what types of opportunities are you looking at today? And does that differ from what you were buying, a couple of years back? And where I'm going with that question is, number one, the class of asset that you're buying. And also, is it a fairly hefty value add play that you're looking for?
Yeah, that's an interesting question. So today we're actually looking at, mainly we're focused on Class B, multifamily properties. So anything in the 80s, 90s, maybe early 2000s. And we used to see returns of about anywhere between 16 and 20% IRR. And now the returns are shifting and they're between 15 to 17% IRR is something that this is what we see today in the market. The new kind of type of assets I'm actually looking at right now is Core Plus, which is newer buildings that need a little bit of renovation. And we found, surprisingly, that some of those newer assets, though even 2014 or 15, their returns are pretty similar to returns of a building that was built 20, 30 years ago and needs a little bit of a heavier value add. So we see opportunities today with about 13 to 15%, not even 15, but 13 to 14.5% IRR. And it's lower than value add, but the delta is not significant enough. So we're also started recently to look into those type of properties. And I think a lot of investors don't look at those because they think that the returns are not there. They're definitely lower than other properties than, Class B or C, but they're definitely, sometimes they're not that low.
Mm-hmm. Got it. And just to get some clarity on using the IRR metric, I don't know what your hold period looks like on most of your investments, but are you utilizing an expected exit to calculate that number? And if so, what might one expect today as far as like investing in the type of things you're investing in? true annualized cash on cash return based on where the debt's at today, agency debt? Where's it, are we in single digits? Are we in double digits as far as cash on cash annualized returns?
Cash on cash, I think we're still in single digits. So right now, anywhere between 7 and 9% is great. If I see an investment with 10% cash on cash, usually it would be not a red flag, but I would ask more questions, understand if it's not a risky investment, if it's not in a crime zone, that there's a lot of risk there, or if part of it is development or mixed use, there's something there, because properties don't generate that much cash. But again, there's so many opportunities that obviously don't cover all of them. It's definitely possible that you can have 10 and 12 and 20% cash on cash, maybe in other markets than what I invest in. So,
sure.
And it really also depends if we see, 20 and 25% cash on cash. But the question is, we just need to make sure that, when I say 7 to 10% cash on cash, I usually don't include the proceeds from the sale, just to be on a safe side. So I don't know if I actually answered your question.
Yeah, no. So it sounds like your projections, typically you guys are looking to exit out in a, predetermined time frame, 5
to 7 years.
Yeah, and obviously everything's up for, to change based on what the capital markets look like and, what the real estate market in general looks like. But generally speaking, that's what your projections show. Okay, you answered the question. Thank you.
Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
What do you foresee as, I guess, let me ask a different way. What are some of the things that really excite you about the market we're in today and, the part of the cycle that we're in? And then on the flip side of that question, what scares you? What keeps you up at night?
I can start with what scares me. Seeing the prices that other companies are paying for real estate. And that scares me because it's definitely going to affect the market moving forward. It affects it already because I'm losing deals to companies that bid a lot higher than me. And I mean, either they're very comfortable with a lot lower returns, but I think mainly they're being a little bit too optimistic than they should be. So we always, when we analyze deals, we always look at the worst case scenario and we assume that the market is actually going to be worse when we sell it. And if we think, right now, if rent growth is 4% a year, we will, put 2.5% or 3% in our calculations just to be on the safe side. So that's what scares me.
Yeah, what are some of the red flags that you're seeing on, and we're not going to name any particular syndicators or companies out there, groups, investment groups, but what are some of the big red flags that you're seeing as far as, them being too optimistic? Obviously, you meant, the rent growth, there could be a period of time where you might not receive rent growth, right? And I can attest to the fact that we owned a good bit of multifamily property back here in Southwest Florida and a ton of single family rental homes in 2008, 2009, 2010. And I can tell you that there was a period of time where rents were stagnant or actually went down due to an oversupply of product on the market, and they surely came back, but they don't always go up. I mean, there could be stress in individual marketplaces that can, create a stagnant effect or even, force you to decrease or offer concessions, which ultimately have an effective decrease. So that's one of them. You probably see guys that are just being overly optimistic on their rent projections. But what are some of the other big ones that you see are just red flags, with some of those guys out there that are, perceivably overpaying for properties?
Yeah, another major one, and I wrote a Forbes article about that, is the exit cap. And I found out that the vast majority of passive investors don't look at the exit cap rate and they don't ask about it. So cap rate is the ratio between the purchase price and the NOI, which is the net operating income. And NOI is basically how much money you have left by the end of the month or the year. It's usually on a yearly basis, after all the expenses are being paid, but before you pay your debt, the loan. So right now in the U.S., it's cap rates are around 5%. That's on average. So if I bought a property with the 5 cap, and I'm assuming that I'm going to sell it at the same cap rate, or I saw some investments with lower cap rate, say 4.7. That's, in my opinion, that's a riskier investment or a very aggressive underwriting, because you're basically assuming that the market is going to be better when you sell it. Because usually the lower the cap rate, the higher the price. So what we do when we underwrite, we always have a cap rate that is higher than the cap rate that we bought the property with. So just to be on the safe side, because we think, okay, right now the market is great. It's probably not going to be as strong forever. It's probably not going to be as strong 5 or 7 or 10 years from now. We want to make sure that when we sell the property, we're aware of that. And that should reflect in the returns. And it's amazing how much this small number that looks insignificant to many investors is actually very important, and how that affects the returns.
Well, it's huge. I mean, if you see marketing materials out there, and we've got some very nice marketing materials, but we're also very conservative. But you see other folks that got very nice marketing materials. But then if you really dig into how they're arriving at those overall, projections or the IRRs that they're stating, you got to understand all the components that make that up. And the exit cap it's one of the primary components that ultimately determine what that range looks like and what that might look like for that investor. And obviously times change for the better and for the worse. It's just, I agree with you on that. It's better to be conservative, although you may miss out on deals. You may miss out on deals and we may get the timing wrong to where we could have bought it and could have got out in 5 years. But at some point in time, you're playing a game of hot potatoes, right? Someone gets caught, with a hot potato in their hand when the music stops. And so you surely don't want that to be you, and I don't want it to be me. And I don't want it to be our investors either.
Yeah, absolutely. Absolutely. And, you asked me before what excites me. I think seeing how multifamily affects the trends and how it actually reflects the differences in trends in society, that's exciting for me. So for instance, starting renovating, allocating part of the amenities for yoga room, or we like to have, if the local tenants populations are, they're young people who work from home, then allocate a small part to be a shared office space. That's exciting for us. So just to take the property and find out creative ways to add value, for me, that's exciting. An area for a kind of a dog wash station. For me, that's what excites me, just to add some creativity. There's always, some people think that real estate is a little boring and not creative. It's not true at all. You can always be creative if you look at it, through a certain lens.
What are some of the more creative ancillary revenue streams that you're seeing that have popped up in this space? I know, for example, the one that I saw was, and it's a couple of years ago, but kind of like the concierge waste service, where you just sit your trash bag outside your door and someone comes and picks it up, so you don't have to walk into the dumpster. But what are some of the other ones along those same lines that you're seeing pop up that are exciting? Because every dollar you add to the bottom line is an increase in value.
Yeah, absolutely. So I think smart homes are pretty big right now, and tenants are willing to pay a little extra to get an apartment that has smart homes. So like Nest, for instance, it's not that expensive, but they're able to control the temperature from their phone, and that's huge. There's going green and having Internet of Things is affected multifamily recently. So I think definitely smart homes is part of the trend that is picking up pretty fast. And it depends on, it's not a cut and paste in all properties. Really depends. If the population's a bit older, they might not, they might like certain trends and not others. So we don't just buy into a trend blindly. We try to adjust it and understand the tenant base and adjust it based on that.
Got it. So I want to switch over to deal sourcing and talk a little bit about how you guys are finding deals today. What's the primary source of where your opportunities are coming from?
Because we are buying large multifamily deals, mainly 100 units and above, we're actually focused on our relationships with brokers. And we started with mostly marketed deals. So, most deals were online we were looking at the large brokerage firms like CBRE, Cushman & Wakefield, Berkadia. And once we started doing that, over time, we built relationships with those brokers. And now, I actually get phone calls from brokers saying, we have a deal, we haven't put it in the market yet. Would you like to look at it? And so through those marketed deals, we actually have access to off-market deals. But there's still some good marketed deals out there. It's just harder because obviously, you have more competition and you have a larger number of bidders, and sometimes you don't know if you bid against yourself. But that's how we source deals.
Got it. And what advice would you give a listener that might be new or just putting their stepping their foot into the multifamily space, that whether or not they have experience in other types of real estate investing, let's just assume they don't. What advice would you give them in order to properly gain credibility from brokers? We all know that brokers make their money by transacting a deal, right? And putting myself in the shoe of the broker, I'm going to only take that deal to folks that I know who can execute, right? That actually have the wherewithal to do it. I'm not going to waste my time on someone that, that doesn't have a track record, that I don't know if they have the financial means to do it. I'm going to go to my pretty much qualified buyers, the ones I know are qualified buyers. So how does that new guy or that new gal truly get their foothold in this highly competitive space?
So there's so many ways to do that. I think the basic thing is to know your investment criteria, by heart. So when they ask you, what are you looking for? The exact markets, the unit size, the deal volume in dollar amount, if it's B, C, or D, if it's core plus, the type of or value add. That shows that you know what you're talking about starting here. And then building credibility is an art. You need to follow up with them for every deal that you're looking into and explain to them why a certain deal didn't work out. When you first start, if you can have a proof of fund letter from the bank or your accountant saying that you have, a certain amount of net worth and a certain amount of liquidity, you can present that when you just start, interacting with brokers, because that helps them understand, okay, this person has the money to buy it. He's not just talking. And if you don't have that cash flow or the liquidity, you need to partner with someone anyhow to close deals. So bring information from that person and you can present it, of course, as a partnership. And that helps you get through the door and being taken seriously by brokers.
Got it. No, that's great advice. That's great advice. And I'm going to switch gears a little bit here, Ellie, as we, kind of round out the show. You've been doing this now since, you said 2010, since you got involved as a passive investor. So we're 9 years into that endeavor of passive to, then to a active investor. But ultimately, you've been in the multifamily space for, a little over 9 years. If you can go back into year one of when you first started, just buying multifamily real estate, again, I know it was passive initially, but generally speaking, if you go back to year one, knowing what you know today and give yourself some advice, what would that advice be?
Buy as many properties as possible and invest in as many properties. And you probably hear that all the time from all your guests, everyone. But we've been on such a great, cycle right now, part of the cycle. I would not hesitate and invest in more properties. I wouldn't tell myself to move to active investing and be a syndicator before I was ready for that. So I wouldn't change that, but I would definitely change the, invest in more and start, as early as possible.
Yeah, no, that's good advice. And the interesting thing about that question and your answer is, I've talked to guys that are in their 80s, right? I've had guys in the show that have been through, 4, cycles or 5 cycles, and they've been investing since they were in their 20s, and huge portfolios of real estate across the country. And they answer it in a very similar manner, but with a longer time horizon. So they'll say, basically, I wouldn't have sold anything, and I would have bought more, just in general, right? Because time heals all wounds, even if it means you overpaid for something, and ultimately, real estate is one of those things that, time will heal any mistake you might make as far as overpaying or, buying an asset that might be slightly more challenged today that maybe didn't hit the returns or the metrics you were hoping. But over time, ultimately, unless you bought literally in the worst part of town and it's only getting worse, right? There's caveats to that. But in any event, typically time will heal all wounds as far as a real estate transaction is concerned. And a lot of these guys are, I would have bought more and I wouldn't have sold anything.
Yeah.
So I know that's not really all that possible, to necessarily, not sell anything. Sometimes you got to recapitalize, but if you got the choice to keep buying and not sell, then ultimately that could be a good, thing to think about. But Ellie, this has been an absolute pleasure having you on the show. And now I'd like to enter into what we call the Golden Nugget segment. And you've shared a ton of Golden Nuggets already, but if you had just one last Golden Nugget, in your pocket that you could share with our listeners that may inspire and motivate them as they progress in their real estate investing career, what would that one last Golden Nugget be?
I would say it doesn't matter if you're starting as passive, if you want to stay passive investor or become a syndicator, just listen to your gut and go with someone that you like and go with someone that if you're trying to learn from someone, then invest with someone that does what you want, maybe in a perfect world, but that you want to do. And that helped me a lot. There's so many, investors out there today, and how can you choose who to go with? So I think if you find someone that you feel comfortable with and you like and you trust, then that's the first thing you need to figure out before you even look at the numbers, before you look at the opportunity at the market. It starts with people. And I think if you look at the most successful people in the world, they do business only with people that they like and trust. So I think that's what I'm also trying to implement in my business. And and my professional life.
Yeah, no, that's fantastic, Ellie. This has been an absolute pleasure having you on the show, and lots of great information that you shared. And so, folks, to learn more about Ellie and her business and what she has going on, you can visit her personal website. That's ellieperlman.com. That's ELLIEPERLMAN.com. Again, ellieperlman.com. And also be sure to check out her blog and her podcast as well. Ellie, can they find all that information via the podcast and the blog and even your investment company? Can they be directed to that from your ellieperlman.com website?
Yeah, if you go to my Ellie Perlman website, you can see links to everything, the podcast, the blog where I focused mainly on passive investors and guide them through the process and give them tips on how to vet sponsors and deals and kind of basic information and more advanced information about multifamily investing. But it's all in the website.
All right. Fantastic. Well, Ellie, that's all we have for today. So thank you for joining us. And until we talk again, just keep kicking butt, girl.
Thank you, Kevin. It was great. It was a pleasure.
Take care.
Congratulations. Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.